Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Donald Trump moves to fire Fed Governor Lisa Cook over allegations she falsified mortgage documents. But Cook refuses to quit, challenging the president's authority to remove her. Meanwhile, the US president is threatening fresh tariffs and tech export restrictions, taking aim at digital services taxes that he says discriminate against American tech giants. Plus, we watch French bond markets and stocks for a second day after Prime Minister Francois Bayrou calls a confidence vote that could topple the government as soon as next month.
In the meantime, quick check on these markets. Risk sentiment starting to look a little bit soft. The futures picture is certainly weakening, down about 0.3% on Eurostoxx 50 futures. FTSE 100 right on its heels, down about the same margin. We did see a bigger move lower in the dollar. It seems to be pairing some of its losses from earlier in the session. 116 on euro dollar, 134 on cable. The countdown to the opening trade starts right now.
Tuesday morning, the president's going to fire Lisa Cook. That's the objective. That's his aim. The markets seem to be shrugging their shoulders this morning, which I think is quite curious. You would have thought this would be a massive moment for the Fed, for the government, for the US dollar. None of it. You've basically got a dollar that has recouped most of the losses that it saw overnight. You've got equity futures that are going nowhere in a hurry. Bond market's barely blinking. I'm quite surprised by all of this morning. This feels big, but it isn't.
Well, yes, it isn't. But if you squint the other way, you can see a little bit of market impact. I mean, the dollar index is down 0.1%. We do have a bit of steepening in the Treasury curve.
Yep.
I take your point. It's not as extreme as perhaps you might have expected it to be if this were the first time we'd heard about this. But maybe this is because this story has not played out. This is not the end, is it? I mean, we've heard from Lisa Cook overnight. She's put out a statement herself via her legal team saying that she disputes President Trump's authority to fire her. She's not quitting. She says there's no cause. And we all know that if he wants to get rid of someone from the Fed, he needs to have cause. Bloomberg Intelligence, their litigation team, offering some interesting analysis here, saying that she can challenge, and in their view, she could win a challenge, saying that Trump would need to show actual wrongdoing. Without an investigation, that is very difficult for him to do. And to get through an investigation would take a long time, possibly missing any February 2026 deadline, if that is what he's trying to do, reshape the Fed ahead of that 2026 date, when a number of terms, of course, are up and certain Fed governors will need replacing. But we do see, to Guy's point, not extreme market reaction, but maybe a little bit at the margin.
But I think maybe the initial shock is still worth mentioning, because we are now seeing a pattern develop when it comes to how the White House is viewing the folks at the Federal Reserve. But maybe because this is yet another data point and a pattern we already knew was established, perhaps that's why we're seeing this pared back. From actual policy implication, Anna's right. The legal implications and the investigation that the DOJ has opened is likely to take some time. The DOJ is not known for a speedy process.
The market's assuming that Trump's going to win, though. And we heard about Lisa Cook a few days back. Market priced it in then. We've now got him effectively pulling the trigger on this. The market is assuming that ultimately he will get his way. He will get to impact the Fed. Where we go from there, I think, is a more interesting debate. But we aren't getting a big market reaction around this. We're
not. But to your point, though, if the market is assuming that Trump wins, then the market is pricing higher yields at the longer end. And that can be seen as a reflection of maybe him having some success, or at least threatening to have some success over the Fed and to limit the Fed's independence.
Absolutely. That's something we're going to talk to our market guests throughout the hour about in terms of what the trade actually looks like in terms of processing this information. We have another threat coming out on the trade front when it comes to where Donald Trump is thinking, this time on digital taxes, which I kind of thought was a closed case. If we had 15%, I know I say that and I completely eat my words. We had 15% on the EU, established that was hitting autos and pharmaceuticals as of last week, and we saw that market reaction. Now reopening the story of digital taxes. And we know this has been a real sticking point, not just with the EU, but with the UK, but Switzerland, with Canada. Carney last week had pulled down some of the digital taxes as an olive branch to Washington. It's not really getting much reprieve when it comes to Donald Trump. I had to look up some of these rates. We're still at about 7% in some parts of Europe, 3% in France, Spain, 2% right here in the UK. I'm just not sure anything can be done about it if this is something that goes through the courts.
Again, is the takeaway here that the president wants a trade war? We had a deal. We thought we had a deal. No. We don't have a deal. We're going to start with another angle on this, and we're effectively going to put everything back on the table, because the theory's always been that if things are left unresolved, then the deal isn't ultimately done.
Yes.
And we're back to arguing about digital taxes, and he's talking about export restrictions. This is not a done deal.
Yes, maybe the first 8 months, first 8 months or so of the trade war has been all about goods, and maybe we enter a new front. There's a new front here around services, and that's perhaps what President Trump is opening up. We'll watch European tech companies as a result of this. But it's interesting that the Europeans did say specifically, they spelled out after the trade deal was arrived at around goods that digital services were not up for discussion. They were not on the table, and some of our reporting making the point that there are lots of things still unresolved about the trade conversation, and maybe Europe is still keeping this one up its sleeve to play when it wants something else on drinks, for example, which is still unresolved.
I would say something that affects the French market, notably.
The French market's going to be interesting today. It was interesting yesterday. So the sell-off in bonds came late in the day, which I thought... So I think we're still factoring some of that in this morning, so it's going to be interesting in 24 minutes' time to see exactly what this open is going to look like. Macron's given the green light. Parliament's coming back early. We're going to have a vote. It looks like it's going to be on the 8th. Are we back to French politics being unstable? What are the implications of that? This is about a spending bill which he's struggling to get through Bayrou. The market's already pricing France at a discount to the rest of Europe at this point in time versus where it was a year ago. Basically, since the snap election, we've been in a position where French bonds have been gradually weakening versus their peer group, and certainly peripheral Europe has had a much better time of things than the French government, than the French bond market has. But again, where does are we heading for at some point a big blow up? So you've got the UK at the moment, and you've got the French bond markets. Both of those, every time I talk to an investor about both of those two markets, there's this risk hanging over both of them. The UK could blow up. You've got a fiscal problem emerging. You could see a trust-like moment coming through. Are we going to see another French political moment that causes consternation and has a ripple effect across Europe as well?
Right, and of course the comparison the market is watching right now when it comes to France is Italian bonds, and working out watching to see whether French yields go higher than Italy. That seems to be, there's 8 basis points as of yesterday's close between them, so we'll watch it in 23 minutes' time whether that changes. You mentioned the bond market sell-off came late in the day. The CAC 40 sell-off came late in the day as well, and we ended down 1.6%.
Yeah.
So this is something that is sticking to markets, perhaps took some people by surprise. We have much more liquidity in markets here in Europe today. The UK was out yesterday, and that makes a difference to liquidity across the region, so we'll watch, of course. And as Tom was making the point at the end of the last hour, if all the parties do what they say they will do in terms of voting against Bayrou, then he's gone. So we'll have to read between the lines, get more nuanced explanation from Paris as to whether that is exactly what's going to happen.
Do you remember
here.
how long it took to form the Bayrou government, to find somebody that would actually take the job? Are there other names being talked about? It is a struggle. Are we heading for snap elections? And what are the implications of snap elections? You bring Marine Le Pen, what's happening around her back into the... so much could erupt in France at that point.
Yeah, or Jordan Bardella if he ends up taking that spot, or else. I think the other piece of this as well is that after September 8th, which is the no confidence vote, the budget was due to hit Parliament, I think October 1st was supposed to be the date. So you basically have 4 weeks, in theory, to find an alternative, which, as history suggests, doesn't really work.
Well, it's hard to do, and the names on the list are getting shorter and shorter. Robert Dishner's going to join us very shortly. He'll be interested in all of this from NEUBERGER BERMAN. He's a senior portfolio manager for multi-sector fixed income and head of trading for London. Wow. Kit Jukes, SocGen, Chief FX Strategist, that's easy to read. KIRAN GANESH, UBS Global Wealth Management, Chief Investment Office, Multi-Asset Strategist. And Ollie HANSEN, SAXO Bank, Head of Commodities Strategy. Again, quite easy to read.
a pretty great all-star lineup. We'll talk about some of the data that we're watching throughout the day. Of course, all day, though, Mark Carney is in Germany. He's continuing his European tour there. I think we're expected to hear from him later this morning, so we'll keep an eye out on those comments. We're also getting comments from the ECB's Villeroy speaking in Bordeaux. Those comments hitting the wire at about 11:45 UK time. And then the focus shifts over to the States. We have U.S. durable goods at about 1:30 UK time, and that Conference Board consumer confidence, whether or not we see people looking through some of the tariff, trade, recession uncertainty.
The indication, if you look at the UMISH data, the indications are maybe actually the consumer is getting concerned. And you can certainly see that. Maybe you could argue in the good Walmart numbers that we saw a few days back and kind of what they're telling us about what the consumer's doing as well. What else do you need to know this Tuesday morning? Let me tell you, President Trump has insisted that South Korea stick to its terms, the terms of its recent tariff agreement, including hundreds of billions of dollars of investment in the United States, despite lobbying efforts by the Korean president. This is happening during their their first in-person meeting that has been taking place at the White House. During the visit, Trump also said he'd like to meet the North Korean leader, Kim Jong-un, this year. This as South Korea's president floated the idea of constructing a Trump Tower in the reclusive country if diplomatic relations improve. Let's talk about what else the president has been saying. President Trump says Vladimir Putin's personal dislike of Ukraine's Volodymyr Zelensky is stalling a meeting between the two leaders. The White House has previously said it believed Putin agreed to a meeting with the Ukrainian president and that we are seeing some planning underway. But the Kremlin never confirmed their commitment and no summit has yet been scheduled.
That was not easy for him to go to Alaska, for him to come here. But the fact that he showed up on a very successful day, it was a very successful day for other things, because, we're also talking about missiles, nuclear. We're talking about a lot of different things. We're talking about limiting nuclear weapons. We'll get China into that.
It's interesting, that's where the president is putting the focus. Orsted shares fell to a record low after the Trump administration blocked construction of an almost finished offshore wind farm, throwing a wrench into the Danish company's planned $9.4 billion share sale. Orsted's management will meet with investors and advisors in London today to reassure them that the planned rights issue will go ahead despite the growing crisis. In some ways, Orsted made a massive mistake by basically announcing the rights issue and leaving a huge gap between the announcements and the reality of that. The risk was therefore that you were going to see more bad news being priced into the stock, that was going to get more and more difficult. And we are now seeing that happen. It is a much more difficult position that Orsted now finds itself in versus where it first announced that rights issue.
Yeah.
And you do wonder how much, if the stock was to fall much further, how viable that rights issue would actually be.
Yeah, and they're going to talk to investors about that very subject today. And overnight, we heard from the Trump administration, then Kriti, that they are suspending development of another wind farm offshore. Now, this one is not 80% complete, as the Orsted one is, and it's also of less relevance, perhaps, to European stocks. But still, it's part of a series. This is in Maryland. It's developed by US Wind, but it's yet another of the wind farms that President Trump is taking issue with.
Yeah, this is going to be a sector crucially to watch at the European Open. Do we see a rebound in Orsted shares, for example, just given the massive hit that it took, but also the ripple effect into the broader wind sector, of course? Is there an Orsted-specific story, or do you see it show up in the likes of Vestas and Nordex? Yeah,
and Orsted was down 16% yesterday. Coming up on the programme then, Puma shares make their biggest gains in over 2 decades after attracting interest from the Pinot family. We'll see if the rally continues today. We'll get a few more details on that story, in fact. Plus, credit remains 3 times less volatile than government bonds. We'll dig into the tightness in the market. Up next, markets are reacting to Donald Trump's move to fire the Fed's Lisa Cook. We'll have the details of that. If you have any questions, if you want to get involved, have your say on any of these stories, then please use the function IB plus BBTV Go to get in touch with the team that puts together the programme. This is Bloomberg.
About 43 minutes away from the opening trade. You are seeing red on the screen. European futures pulling back quite a bit. Eurostoxx 50 futures down by 0.6%. And you are seeing that pain across the board. One of that might just be a risk sentiment story that continues over on from yesterday. President Trump has moved to oust Fed Governor Lisa Cook following allegations that she falsified mortgage documents. But Cook pushing back, saying she will not resign and the president has no authority to make her do so. Her lawyer saying they will take whatever actions needed to prevent the move. Bloomberg's Balazs Pence joins us now for the latest. Balazs, just walk us through where we go again from here. What happens next when it comes to this dispute?
Well, Kriti, what we've seen is a pretty dramatic escalation of Donald Trump's attempts to control the Federal Reserve's policy and the direction of U.S. interest rates after a pretty prolonged pressure campaign, a war of words, if you will. He's moved to take direct and quite unprecedented action. Now, of course, Lisa Cook is pushing back, and in a pretty fiercely worded statement to us, she said that she's not stepping down and she doesn't think the president has the authority to fire her. So now it's likely that this is going into litigation, and the litigation is going to center on the question whether the president had cause to fire Lisa Cook, whether that was established, the grounds for that firing. And in the meantime, Lisa Cook says she wants to stay on the board, she wants to continue serving, and that will be a different question that will likely require a different court decision to decide whether she can do that or not. So whatever happens, we are in for a period of uncertainty and more questions pile up, not the least being the direction of U.S. interest rates.
Yeah, Balash, let's linger on that point, shall we, a moment. What does this mean for the direction of Fed policy? I suppose it will be dictated by whether President Trump is successful, and if he is, how quickly, but also whether it has some kind of chilling effect on the rest of the FOMC. What are we hearing?
That's right. All of those are very important considerations. I mean, look, when we look at September, the market seems quite convinced that there is a rate cut coming, especially after Jackson Hole. But if we look further out, what we see in the steepening of the yield curve, it does suggest that there's a lot more uncertainty coming in. And if there's an extra opening on the Fed board, if Donald Trump gets to nominate one more person, that might just tilt the balance on that board 4-3 in the more dovish side. And that's certainly something that the president would welcome. So you might be forgiven to assume that if that does happen, U.S. rates might be heading lower or more quickly or headed down more quickly than previously assumed.
Yeah, front-end rates. Balash, thank you very much indeed. Balash Pence joining us, Bloomberg News Desk editor. Thank you very much. Robert DISHNER, Senior Portfolio Manager for Multi-Sector Fixed Income and Head of Trading for London at NEUBERGER BERMAN, joining us around the table this morning. In some ways, not much of a reaction. Is that the right reaction?
It sort of is, just because there's a couple different pushes and pulls, right? We have the France news that you were talking about earlier, so you have the French elections on the second side, but also we got that positive SIBO blog post on Friday suggesting that the deficits might be lower in the U.S. So two things that, absent that, maybe we would have seen a bigger market reaction. The other part of it is the market's also been trading in a bit of a range. Is this really going to happen, or is it not going to happen? And so you're sort of left with a bit of a risk-arb type dynamic in the market where it doesn't want to get too far over its skis one way or the other.
It seems the market's struggling to push the 30-year beyond 5% at the moment. And I keep looking for catalysts to kind of get us there. And each catalyst, we seem to fail. Do you think we get beyond 5%? If we don't get beyond 5%, do we see a material impact on the dollar?
Right. Well, that's a great question. I mean, we've been struggling to see the market break 5%, and that's been a bit of a line in the sand, particularly for some foreign investors. We've seen some money come in when rates get that high. Now, if we do break, what does it? Does it go to 5.5? Where does it end up going to? So part of it, though, is that the yield curve steepening that you've been noting, and frankly, the front end's been doing some of that heavy lifting. And that's really on the idea that we're going to get greater Fed cuts, in line. We had been September, December. We're now thinking that October's in play as well in terms of rate cuts. So a lot of that steepening is really the heavy lifting coming from the front end, where maybe that back end does stabilize around that 4.95%.
Well, a lot of that steepening, or at least there's even the rise on the back end, is coming from worries about the debt ceiling and rehashing an issue that really spooked the markets. It feels like it spooks the market every quarter. How do you price that possibility in when you've already seen so much volatility around it as recently as April?
Right. No, it's completely fair. I mean, look, the long end is, we've seen risk premium increase in the long end. So if we take that ACM term premium that they've come up, and we've seen that consistently rise over the course of the year. The other part of it, what does that do for the debt stack? But also, we've seen both the DMO, we've seen, the Fed. Do we issue less in the long end to prevent that from really going further? And then also, what tools does the Fed have in terms of potential Operation Twist or those type of things to prevent an unmooring of the long end? But in terms of the fiscal, again, that's where the news from Friday becomes very important, right? This blog post is suggesting that the deficits could be, what was the number? I think $4 trillion less. Which could help, mitigate some of that long end move. But yeah, I mean, these constant debt ceiling debates are not helpful for rate curves.
Could the debt ceiling debate in the States overshadow the fiscal worries right here in Europe?
I think they're independent of the two, right? I mean, I think people are concerned about what's going to happen with France. Obviously, a big debt market. What are rating implications for that? Bloomberg was reporting earlier when I was up, some softness in French bonds and Asian hours. Obviously a big constituent. A lot of foreigners own French bonds. So how do we think about how all that plays together?
Yeah, it's interesting, isn't it? The futures picture was suggesting we'd see a continuation of yesterday with yields going higher on French debt. London is back in play today, and we have something a little different developing. European bond markets are open, and we see yields coming down, not by a huge amount, but 2 basis points in France. So, maybe that's a sign of some calmness, although I will say that the German yields are dropping more, down 4. So the spread of France over Germany has increased. So take whichever sign you want, Robert, and tell us what you think about France.
Yeah, so, I mean, France is something that we've had concerns on for some time, right? Even before last year's events. And the fiscal trajectory in France is just not healthy, right? Just much like the fiscal trajectory in a lot of other places, including we were talking earlier, the UK, right? How does that play itself out? And so part of what we're probably seeing today in bonds is that softness in these equity markets that you mentioned earlier, a bit of flight to safety, true AAAs, those type of things.
OK, so the flight to safety play in European bond markets sort of outweighing nervousness around debts. But, I mean, in terms of the French story, what are you watching for then? Of course, the vote itself, the vote of no confidence, strike action being called for early September as well. From what we're hearing, it's going to be difficult for this Prime Minister to stay in his post just as it was for the last one.
Exactly. And really, at the end of the day, what we're looking for is, and yes, all of those things, but what is the fiscal story at the end of the day? What does the French fiscal trajectory look like at the end of the day? And if it's okay, then the market will recalm itself. We'll get spreads back down to that 60 level, like we saw a bit earlier this year. If not, we're going to be back to that 80. Or remember, back in last summer, people were calling for 100 or 110. So we're what, in the 70s right now or so?
The spread, France-Germany, yeah, 77.
Yeah, exactly. So we're at the sort of point where either we're going to calm down or we're potentially going wider. But again, really at the end of the day, what happens with the fiscal story?
Do you think people are buying the dip? Do you think there's an opportunity here this morning in EGBs?
In EGBs, yeah, we're constructive European rates.
So if this is so if the French cause a few ripples, this could be an opportunity.
I mean, but does it cause opportunities in German rates? Does it cause opportunity in Italian rates, Spanish rates? Those type of things. Really, where's that opportunity lie? Is the opportunity in SSAs? I'm not so sure that it's in French bonds right now.
But if you are looking to diversify away from the United States, which some people are, is any dip in European govies, if you're a Japanese Asian investor, potentially an opportunity?
Exactly. I mean, because our view is that, look, growth in Europe may not really be there, right? I mean, we just had the German GDP restated, right, to a bit of a negative level.
Yep.
So are we going to actually get the growth that the ECB is forecasting? And might the ECB have to act 1 or 2 more times, over the course of the next 6 months or so in order to support that growth?
All right, Robert DISHNER, Senior Portfolio Manager for Multi-Sector Fixed Income and Head of Trading for London over at NEUBERGER BERMAN, walking us through those dynamics as we speak. I was just doing a little bit of digging, guys, on this. We're now at a spread, as Anna was mentioning, with this open, about 77 basis points. That is the highest going back to April 22nd, but it's definitely not the highest that we've seen in the last year. So I don't know how much of a freak out this really is.
Yeah, well, and certainly bond yields are moving in a different direction to what the spread story is telling us, aren't they? Yields coming down, actually, here in Europe this morning, but not by much, down a basis point. We'll wait and see how the French story plays out as we work our way towards the market open. Coming up, we'll stick with France. Prime Minister Francois Bayrou has called a confidence vote that may topple France's government as soon as next month. How will stocks respond in half an hour? We'll continue to monitor what's going on in the bond markets and the euro. This is Bloomberg.
Tuesday morning, how are you doing? 30 minutes to the start of equity trading here in Europe. We've already got the bond market open. A few surprises maybe coming through there. Kriti will get to that in just a second. Let me show you what the futures picture looks like. You are negative. So it's interesting here. So what you've got this morning is bond markets actually not doing very much, and in some ways, actually, the French bond market looking much more positive. But what you do have is CAC futures down, and they sold off pretty hard into the close yesterday. you're getting a ripple effect across the rest of Europe as well. Some of this is Lisa Cook, some of this is French politics. It's hard to determine which is which, but the aggregate is basically the picture you see in front of you.
Well, let's take a look at the bond market as well. The futures market very much pricing it in. The bond market, dare I say, feels a little bit steady. We'll see how long that actually continues. We're looking at 3.5% on the French 10-year as well. It was that spread widening yesterday that we saw between the French and German debt that's going to keep us on our toes. We also have our eye on the French and Italian spread as well. Nevertheless, it comes down to, as Guy was saying, the politics over in Paris. Prime Minister Francois Bayrou has called a confidence vote that may topple France's government as soon as next month. Three political parties immediately saying they would vote against the motion.
This is why I asked the President to reconvene Parliament in an extraordinary session on Monday, September 8th. I will engage the government's responsibility on that day with a general policy statement in accordance with our Constitution. This general policy speech will pose the central question, whether the danger to the nation is serious, whether there is an emergency or not, in order to choose a path to regain control of our public finances.
Bloomberg's Caroline Conan is all over the story, joins us from Paris this morning. Caroline, just walk us through the steps from here. How likely is it that come September 9th, let's say, Francois Bayrou is no longer the Prime Minister of France?
The chances are pretty high, Kriti. If you just do the math, technically, the national rally of Marine Le Pen and the far left of Jean-Claude Mélenchon immediately said last night after the Prime Minister's speech that they will vote against the Prime Minister. The Socialists, however, with the First Secretary Olivier Faure, were a bit more vague. Last night on the 8 o'clock news, Olivier Faure said that in the current state of the budget, he cannot support François Bayrou. He cannot vote for the confidence of François Bayrou. However, the Socialists have also said that they will present an alternative budget over the next few days. We'll see if this slightly moves the needles. At the moment, the market seems to be pricing that François Bayrou will indeed fall on September 8th. 8 months after his predecessor, Michel Barnier, also collapsed last December over the previous budget. So clearly this is the headline of every French paper this morning. La crise, the crisis. François Bayrou is provoking this confidence vote by himself, anticipating the social anger and the general strike that was planned on September 10, anticipating possible overvotes of confidence on this budget that were supposed to be planned for October, so perhaps provoking his own fall.
Caroline, thank you very much. Caroline Conan with the latest on France. So the French story clear to see in European futures, with the CAC 40 futures picture looking distinctly negative this morning. A little more muted in bond markets today than yesterday, as Kriti's been saying. The euro then, what's at stake in FX markets? Let's talk about FX now. Kit Jukes joins us, Chief FX Strategist at Société Générale. Kit, good morning to you. So what is at stake for the euro here? Because, OK, it's France, it's not the whole Eurozone, but, you know, all other things being equal, you might expect this story maybe to put some downward pressure on the currency, but then we have the Cook story putting a bit of downward pressure on the dollar. What matters in all of this for the euro?
I've felt over the course of the summer that what matters in FX is what's going on in the United States to a degree that is unprecedented. So we can throw other things at it, and I can question that a little bit, but I can't remember a market where it was so sort of one-dimensional in the sense of US economy, US rates, US politics. All of it is so uncertain, up in the air, and important that it kind of, you know, everything else it's definitely secondary. Now, you know, and I think to be fair to this story, in a sense, you know, you could have another election tomorrow in France. We'll get another coalition government gets formed that's not really very stable, that doesn't have a commanding majority and can't do much. So the only thing that could happen in France, I guess, is that you could get to a situation where you could get some sensible policies or some forward-looking policies in place to generate some growth, to sort out policies, to sort out the fiscal position.
That could happen.
But not very likely.
Not
but
very
the
likely,
alternative
but
is the status quo.
So a uniquely US-dominated market is the way that you would describe things right now. But sticking with this French theme, what would make it cut through? I mean, if we saw a spike up in French yields, the spread with the Bund really, jumping again, or if we saw it go substantially over Italy, I mean, this is such a turnabout for the Eurozone. Is that going to cut through at the sort of big picture level?
I don't think it cuts through much in FX. I think it is a big story in the bond market, clearly. People trade the BTP OAT spread, the French-Italian spread, and they will continue to do so. They'll continue to argue, I think, quite a lot of people that Spain's finances are as good as France's and so on. So I think all those arguments continue and get fed by this. And it is important for Europe economically in the sense of we have this attempt at fiscal stimulus. I mean, coming from obviously getting rid of the debt brake in Germany and then the need for defence spending. Having a no government, weak government, very weak coalition government in France doesn't help. But I think that's the status quo. I don't think this changes that. It doesn't make it worse.
Trump wants to fire Lisa Cook.
Apparently.
I'm not seeing a massive reaction to that.
No, I think a lot of it was in the price that he's trying to do that.
Is this also
yes.
the status quo? That he's effectively going to win and reshape the Fed and we get lower rates. Is that already in the price?
Some of it is. We assume that they're going to issue mostly short-term debt, not long-term debt.
Yep.
We've taken that one on board. We assume that their fiscal position's pretty scary, and I assume that Donald Trump wants a weaker dollar. I mean, he really wants a weaker dollar, and he's going to get a weaker dollar because he's doing quite a lot of things that help. I don't think he can get it that much weaker because I'd have to buy something else on the other side.
Right.
I have this nagging thing always at the back of my mind that when I started work in 1984, the dollar went extremely high.
Yes.
And then in 85, 6, 7, it went all the way down without a recession or anything else because everybody eventually just got out of their long positions. That's the only way the dollar goes down a lot. I think euro-dollar in the mid-120s, back where we were at the high when we, after the Fed cut rates aggressively in 2020. That's sort of imaginable. 130 seems to me very painful. It also can't happen too fast because the disinflation it gives for other people is quite painful.
This is just a slow grind lower.
It's an annoyingly sort of uneven one. In other words, there'll be days when euro-dollar goes up 3 figures and everyone says your forecasts are too low. And then it goes back down 2 and they're too high. And that's what life's going to be like.
But you take a step back and look at the long-term trend. And
you have to.
OK.
How much of the ex-date matters in all of this? Or is this purely about monetary policy?
It's not just about monetary policy, but, I think... I've had a sense for the last few months that because of all the uncertainty in markets, that we're almost trading growth expectations, that we've gone back. If you can't rely on anything else, if you don't know what risk on means for currencies or anything else, you go back and say, who's got the best growth outlook and who's got the worst growth outlook? I'll have the currency of the best growth outlook.
Isn't it America?
That's why the dollar's so high. But is it getting better, their growth outlook, or is it getting worse?
Okay.
So that's,
Is it? You tell us.
I think their inflation growth trade-off has deteriorated enough that the economy is going to slow. And I think this is what we'll find out most in the next couple of weeks. The most perverse reaction in markets, and it's a normal reaction to me, is any spike in inflation in the US is very dangerous for growth. Round about now, there's a lot of American parents turning up in a mall looking to buy their kids a new laptop and looking at the price or whatever else they're buying. If they find that sufficiently painful that they spend less in real terms, the American economy is going to slow.
But is that net positive for the dollar?
No, that would be net negative for the dollar, as simple as, I think.
But why, when historically, when you do start to see growth slowdowns, even in the United States, or even the fears of recession kind of sink back in, you've seen strength in the dollar? Because
the $61 trillion of U.S. assets everyone else has bought on the dream and the realization and the confidence that U.S. assets are going to perform, that bond yields are higher, equity performance is better, everything is better about the U.S., is being already undermined by the clear sense that President Trump wants a weaker dollar. And if you're looking at it and thinking, can I have a weakening economy and these equity valuations? And I know equity analysts who think we can because of where that strength in the equity market comes from, but I think that starts to hurt the dollar.
Friday seems like a long time ago now, Kit, doesn't it? It seems like so much has happened just since last night in terms of President Trump's agenda and lots more news. But Friday, of course, we saw the comments from Jerome Powell that caught the market wrong-footed a little bit about what he saw as the downside risk, despite some people had said the minutes had a sort of hawkish feel to them, a focus on inflation. A lot of the other Fed commentary had been focused on inflation. Should we have been as surprised as we were, do you think, about what Powell had to say? Because this will come back when we get the next data.
I was certainly surprised. I thought that it looked, when they set out the agenda for Jackson Hole, all about the labour market, all about, in other words, a labour market where we know we have ageing populations, we know we have an unemployment rate that's being held down even as employment gets weaker. All of that says more and more difficult inflation growth trade-off. Oh, we can't cut rates too fast because, we've got upside risks to inflation. So
that sounded like an inflation-focused conversation.
Yeah, just from the papers that were going to be presented. And then he stands up at the beginning of his thing and he kind of, gives the game away before we go through any of the material. So, yes.
But everything I read over the weekend suggested that actually, on second look, the speech was nowhere as clear. The market kind of saw what it wanted, felt it got what it wanted, and therefore reacted.
Well, the Fed got the headline
such.
it wanted.
Yeah. But is the reality as...
OK, there's two bits to it. I mean, the first bit, so he presumably had that one paragraph in there, knowing how I would react, because we're all simple people.
Yes.
The second thing, to your point, that I think is more important is we've still got the ISM data to come. We've still got the payrolls to come. Frankly, if payrolls are at 300,000, none of this matters.
If they're north of 75,000 and CPI and PCE's hot, does it matter? Is there anything that blows off the market off 25 basis points in September?
Yeah, something significant. So 200,000. It's got to be big enough to. We're going to work it through with what happens to the revisions, and we're going to have a terribly tough time working it out. But yes, if you get a sense that last payroll number isn't the sign of a clear downward trend, because you know that there's inflation coming through from the tariffs. You don't really know exactly when, but we know it's coming. That's clear enough.
But does 25 basis points really move the dial that much?
Not from where we are now, because we've gone, we've priced it in with massive confidence. So not doing 25
would have more impact.
Would have more impact from where we are now. I think that's the only way to think about it.
All right. Kit Jukes, Chief FX Strategist over at SocGen, joining us around the table to walk us through these dynamics. We thank you so much. Coming up on the program, we switch focus right back to the equity market. We're going to continue to track Ørsted, with management set to meet with advisors today to reassure them on a planned rights issue, despite President Trump canceling a wind farm that was about 80% completion. That, your other stocks to watch next. Stick with us. This is Bloomberg.
Welcome back, everybody. 7:46 here in London, Tuesday, the 26th of August. Let's look at the futures picture. And the French politics story is evident across this futures story right now. We see the CAC 40, the futures picture in France is negative, down by 1.3%. That follows on from a drop in the CAC 40 just yesterday. So we were down 1.4% by the close. All of that came late in the day, and we have some more of that to look ahead to as we continue to be concerned about what's going on with French politics. And certainly it's cutting through on stocks, even if it's not on the euro. And to some degree, we see calm in bond markets. We have plenty of other news to talk about, whether it's the Fed, whether it's the latest on trade policy. Let's go to Kriti, because I think it's the trade angles that have caught Kriti's eye this morning.
They absolutely have. I mean, we've been talking about this for months, but there is one deadline everyone needs to be aware of today that I think is maybe fell below the radar, and that is going to be India. The tariff deadline hitting in today, the 50% that is expected to at least address or attempted to address some of the issues when it comes to India's dependence on Russia. I'm going to show you the dependence in just a second. We'll start off. Oh, well, here it is. Let's start off with the pie chart when it comes to show just how many oil imports have come from Russia into India. And this part is really crucial here because it shows just how interrelated the two economies are. 39% of their oil dependency from one of the world's largest importers coming from Russia. Compare that to its reliance on the U.S., only 4%, despite the U.S. being the largest oil exporter in the world now. When it comes to what the impact is on the tariff front, 50% rate, as I said, applying on midnight from the United States to Indian exports. There are key markets that this hits, and some of them are ones that are kind of unexpected. We'll flip the boards in just a moment and show you. Shrimp is top of the radar. Shrimp is one of the largest exports for India into the United States, and that's something that's going to hit the bottom line of the United States. Another one is fabric. Gold is, of course, a crucial market as well. Gold and jewelry, major exports coming out of India, and rugs as well. So if you're redoing your house in the States and you are looking for an Indian imported rug, things are about to get a lot more expensive. But for the markets, this is the terminal chart that matters. It's all about the equity story, especially if you're talking about a weaker dollar. Does that incentivize you to get into emerging market assets? Well, according to this chart, India is not the place to outperform. In fact, it's had its worst underperformance relative to the emerging markets complex going all the way back to 1995 and even 1993. That was a stock market scandal in 93. In 95, global recessionary fears really taking down that market. It's been 30 years, Anna, and we are now seeing that same level of underperformance.
OK, we'll certainly be focused on India and see how that move by the Trump administration then, that seems as if it kicks in around midnight Eastern time tomorrow morning, tonight in Europe. We'll continue to watch that, of course, and see how that one develops. Let's get some perspective on these markets, on the big picture around what's happening here. Markets Live Executive Editor Mark Cudmore joins us now. And Mark, good to speak to you. We started this programme with some weakness in the dollar. That seems to have paired even just in the last 50 minutes or so. And Guy was making the point at the top of the programme that maybe the market's not reacting all that much. Certainly FX market's not reacting very much to the Lisa Cook story. Is that because we knew it was coming? Maybe bond markets are reacting a little bit more? What's your takeaway so far?
Good morning, Anna. You're right. Markets are largely shrugging this off. Initially, they did react to the headlines. The reason we've kind of erased those moves is because, first of all, we got the report that Lisa Cook will challenge the kind of decision. And the evidence is very much they'll likely win. Trump has no just cause for allegations of fraud. They're not yet proven. Now, even if they're proven, then he can remove Lisa Cook. But that will take some time. So it's likely if Lisa Cook sues to reinstate her job, she will win that fight, which means Trump's not going to get the change in the Fed on any immediate basis, which means that from the Fed's point of view, it's the status quo. So you shouldn't get any direct impact on the front end yields in the dollar. However, you've got to make an assumption now. Does Trump kind of go, oh, OK, I was wrong and back down and forget the story? That's not been his modus operandi so far. So you've got to assume that he's going to double down on his public attack on Fed independence, Fed credibility, and that is an undermining of U.S. institutions. So it's not a set binary moment just yet, but it's yet another blow, and a big blow. It's a really clear kind of politicized move here because he doesn't have just cause. It's not a legal process here. An attack on U.S. institutional credibility. So that is ultimately bad for long-end yields, bad for long-end bonds, which will see long-end yields rise. It'll be bad for U.S. stocks. It'll be bad for the dollar. It's not yet a tipping point, but there will come one because this is another negative for U.S. assets.
Is the trade war restarting as well, Mark? We've just been talking about India. We can come to that as well in more detail in a moment. But we're now talking about digital taxes once again. You've got all kinds of other issues being thrown around. Are we back to having to price in trade deals that we thought were done, maybe not being done?
I don't think the trade war ever really went away. I'm not sure war is really the right kind of word for it. It's a U.S. attack on the global trade system, which the global trading system has so far been relatively resilient to. Are they going to continue suffering more attacks? Almost certainly. I mean, Trump, even before this one, was talking about his semiconductor chips are coming in another 2 weeks. His always constantly promised maturity for these threats. So, of course, we know that trade is going to continue being a problem, and it's going to continue costing businesses and consumers and affecting global growth.
Mark, in our last 40 seconds or so, there has been a question of seasonality in September. Historically, the market always tanks. The equity market always tanks in September. What do you think could be the potential catalyst or the straw that breaks the camel's back here?
We have a lot of catalysts, don't we? We've got Nvidia earnings, we've got inflation data, there's core PCE, but I think at the CPI one's even more important. We almost know it's going to be higher. It's going to undermine the idea that the Fed's going to cut, which is what everyone's betting on at the moment. We've got jobs data to come. Now, it's an interesting one, the jobs data, because it comes really weak. People will get really worried about the US economy and say, okay, those rate cuts that are already priced are going to come, but maybe we've got a recession coming. If it comes in strong, well, then it completely undermines those rate cuts. So either way, it seems like lose-lose for stocks. Plenty of catalysts, negative catalysts on the horizon in the weeks ahead.
There's the Mark Cudmore we know, the bearish Mark Cudmore. Bloomberg Markets Live executive editor Mark Cudmore joining the program this morning. We thank you so much. More analysis from him and the team. MLIV Go is the function on your terminal. Let's go from the macro to the micro. Hit our stocks to watch with Louise Moon. Louise.
Morning, Kriti. The key one we're really focusing on this morning is tech stocks over in Europe. So there's news overnight that Trump said he might impose additional tariffs on tech stocks and semiconductor stocks in Europe. So he said, as you can see this quote here, we'll impose some additional tariffs on exports. And this is if countries don't make kind of remedies. This is in response to some digital services taxes from European nations. So the key ones we're really focusing on are the likes of Infineon, ASM, ST Micro, SAP. You can see it's been a bit of a mixed picture so far this year. They've had a lot to deal with, a lot of geopolitical news to grapple with. So we'll have to see if and how this impacts at the open. The next key one that we're really focusing on is Orsted. This is a bit of a kind of follow-on day two story. We had news over the weekend that Trump was cancelling a wind farm off the coast of the US that's owned by Orsted, and they saw their stock plummet yesterday, down 16% to a record low yesterday in the session. They are trying to reinsure investors, however, today. They're meeting with investors ahead of a planned stock sale. That's for about $9 billion. They're really trying to reassure. And you can see here there's a note from DNB Carnegie saying that they need a lot less uncertainty to reassure. So we'll see if this boosts stock open. And then finally, just a quick one on defence companies. We're focusing on German company ThyssenKrupp, meeting with Mark Carney today as Canada ramps up its defence spending.
Louise, thank you very much. Our equities reporter Louise Moon with the latest on those stocks to watch. We'll be watching Puma after the stock posted the biggest gain in over 2 decades. The Pinot family perhaps looking to sell some of its stake. That and the stocks open next.
Tuesday morning, good morning. London's back today, so that's going to add some volume into the system that wasn't there yesterday, some liquidity that maybe we need. Yesterday's session in Europe, well, the French story certainly percolating at the back end of the session. That is going to be a story this morning. You've also got the situation in the United States. That's going to be a story. So this was the roll-off that we saw at the back end of the European session on France. That was the roll-off that we saw at the back end of the US session, maybe on a little bit of Lisa Cook. It's interesting that equity markets seem to be where the epicenter of the action is for both of these two stories, not the bond market, Kriti, which I think is interesting.
Yeah, I mean, the pain continues when it comes to the equity market. We'll dive into the bond market shortly. But the pain point this morning that's dragging down the entire index, as you showed on your chart there, was the CAC 40 futures, down already 1.4%, and the market hasn't even opened yet. The FTSE 100 also on the back foot, down about 0.6%. But this is the index that's the best performing on the continent, and it's also down 0.6%.
Yeah, so we look for some general weakness, risk off, being driven by the French story, or being driven by the Lisa Cook story and the Fed. With all of that will have an impact on sentiment, at least going into the European session. In terms of some of the sectors and stocks we're watching, chip stocks certainly in focus, anything tech related. We are, of course, seeing and this is just a sort of sentiment read across from what President Trump has been talking about. He threatened more tariffs against European tech exports. He's threatened export controls on US high-tech equipment as a result of digital services taxes and other things he doesn't like about the way that the rest of the world deals with US big tech. Commerzbank in focus. It's down over 4%, or the expectation is it will be weaker as it is cut by Bank of America. And Orsted in focus for a second day on those wind projects, Guy.
Absolutely. Meeting in London today, big meeting in London today for Orsted with investors. OK, here we go. Time for Tuesday's session. There is a lot to think about, particularly in equities, maybe less so in the bond market, but actually equity markets are where the reaction appears to be coming through. We're going to wait and see what the KIRAN does in just a second. The expectation is it is going to be negative. The FTSE 100, in some ways at the moment, feels like an area, an oasis maybe of calm. How long does that last for, given what is happening in British politics right now? We'll park that one and deal with it another day. Stock 600 is down by 0.3%. The IBEX is down by 0.7%. So you're certainly seeing European equity markets taking it on the chin this morning. Could take a while to get the CAC open. We saw a big move down at the back end of the session yesterday. The expectation, as Anna and Kriti have been saying, is that that will continue this morning. Could take a while to get that market open. The DAX could take a little while to get going as well this morning. But if I look at the right-hand side of the screen and I look at where the IBEX is this morning, so the Spanish market is down by 0.9%. What does that say potentially about those other two markets, France in particular? What are we seeing in sectors? Kriti?
Well, when you look at these market moves, I mean, the pain is very clear that already from the get-go, you are seeing a lot of pressure when it comes to French stocks. From an Intrex contribution perspective, it's a lot of the banks, actually. It's AXA, it's BNP, no surprise there. If you're worried about the bond market, if you're worried about the deficit, that's going to show up in the banks. We've seen this before. On the plus side, though, on the upside, I should say, commodities, basic resources, seem to be having a good day, and one of the only sectors to do so.
Absolutely. Literally the only sector now as we're sort of settling. Oh, no, energy also. So energy and basic resources going a little firmer, as you suggest, Kriti. To your point about a continuation, another day of weakness over in France, we see that certainly in the construction sector. So Eiffage is down by 6.6%. Vinci is down by nearly 5%. Saint-Gobain down by more than 3%. So there was a big focus yesterday in the French market when we saw that sell-off on the CAC on some of those construction names, and that continues to be the case this morning. So another day of weakness on French construction. And yeah, as you say, not much going higher this morning from a sector perspective, still just basic resources and energy.
I think it's interesting. So ASML is an interesting one here. So the Americans are threatening chip export, restrictions on the back of the digital services tax. Yeah. The key piece kind of in all of this, and NVIDIA relies on it, is the high-end kit that ASML manufactures. It'd be interesting to see were we to see some of those restrictions being put in place, what would happen maybe to export restrictions on the kit that ASML makes. A lot of that goes to Taiwan, which is obviously where NVIDIA makes a lot of its chips as well. I just put that one out there.
So ASML going higher this morning, up by 0.4%.
Yeah. It's no surprise that the banks are where the weakness is. BNP Paribas is down by 4.6% at the moment. The French banks have had a great run. And any kind of opportunity maybe therefore to top slice a portfolio and take some of that profit, it would be easy to make that decision, I think, first thing this morning. So no real surprise there. But as you say, there is the connection with the bond market. They do hold
and the French,
a lot of debt.
and the French insurer is also weak with that in mind. So AXA down by 4.5%. It's just one of them, but I see others in the mix as well. So it seems that and we don't have the CAC open right now, do we? The DAX has just opened. It's down 0.7%. The CAC yet to open this morning. A second day of focus on those political troubles for the Prime Minister.
Are they struggling to get open this morning?
Which I think says everything, given it's the last week of August and things should be light. People shouldn't be at their desk. It should be easier to open these markets, and we haven't quite gotten there yet. So we're going to continue to digest into the nitty-gritty of the makeup of these markets. SocGen is doing some of the heavy lifting to the downside.
They can't get it open. They can't get SocGen open, which I think is really interesting.
Well, there you go. I mean, it tells you everything that the banks is, as you said, the epicenter of the question. Let's get a market perspective, if we can, this morning. KIRAN GANESH, multi-asset strategist over at UBS Global Wealth Management's Chief Investment Office, joins us this morning. A pleasure to have you on the program. Thank you so much for your time. We're expecting a lot of pain once we get the French market open when it comes to pricing in some of the politics yet again. KIRAN, talk to us a little bit about how the politics should be playing into how we're viewing not just French stocks, but the broader European complex.
I think it's important to look at where we've come from, because it has been such a strong rally so far year to date on some of the relief perhaps around some of the tariffs, around the tech boom, around, again, maybe some relief around some of the better performance than expected from the economy. And we do think that at this point, markets are pricing in a lot of good news and are vulnerable to this type of political shock. So what we're seeing in France with potentially some concerns that then arise around French debt, what we're seeing with some of the political interference with the Fed in the US, we think that some of this political risk isn't really priced in at this point, so investors should prepare in the shorter term for some increased volatility resulting from this.
But KIRAN, we're kind of scratching our heads as well that we're not seeing as much of a reaction in the bond market as we are seeing in the stock market yesterday and today as well. Is the equity market going to be the epicenter of the pain point here, or are we expecting some sort of bond market freak out, for lack of a better term, as we've seen in previous iterations of the French political situation?
I mean, I think the bond market in some ways might have been a bit ahead of the game here. If you look at a lot of the European bond yields, they are trading towards the upper end of their recent levels. So I think the bond market may have already been anticipating a bit more of this concern around deficits, a bit more concern around, where is inflation going to shake out? Have central banks perhaps cut rates too quickly? So I think that was maybe a bit more already in the price, whereas equities, of course, have been on this very strong run and really haven't been pricing in a lot in the way of political risk.
So what's the best opportunity that you're looking at, KIRAN? There seems to be a lot of uncertainty in markets right now, whether it's the Fed conversation and the shape of the Fed policymakers coming off Jackson Hole on Friday. A lot of people caught off guard there about what to expect from interest rates. Then we've got French politics, a bit of nervousness being created there. Where are you, as we head towards the end of the year? I think we can ask that, towards the end of August. Where are you looking at as the best opportunities?
Yes, so we're really getting ready to buy the dip in equities. We think that the medium and longer term prospects are very strong. AI is a big part of that story. We also think that the US economy is going to have a soft landing. So we think that with that and with rate cuts coming from the Fed, the longer term opportunity is going to be good. It's just that given the strength that we've seen recently, it does seem that the market is primed for something of a short-term pullback. So, we're looking at stocks in AI, companies exposed to electrification, companies exposed to healthcare, waiting for dips, in those areas that might come from political shocks or other things, and then getting ready to increase allocations into that because we think the longer-term prospects are strong. So buying the dips in equities would be our biggest call heading into the end of the year.
Are wealth management customers, are they very attuned to Fed independence? Is this a story that cuts through in the client conversations that are being had?
Yeah, well, certainly, many of our clients are experienced with investing all over the world, and they've sort of seen instances either in different countries or in the past where central bank independence has been interfered with, and that's obviously had some quite significant results. I think in the case of the Fed, and of course, there is much more overt political interference than we've had, at least in recent years. But this is an institution that is sort of used to dealing with a degree of political interference, and we think that ultimately the Fed is going to remain data-driven, even if they have got this noise in the background. For us, we think that means 100 basis points of rate cuts in the next year because the economy is slowing. But we don't think the political interference is going to materially change where the Fed ends up with interest rates in a couple of years' time.
KIRAN, you think equities are going higher. Is that multiple expansion? You just said that you think the US economy is going to be slowing. Or is it actually companies delivering better profits and better numbers?
It's better profits. We saw this in the last earnings season. The US especially seeing very, very strong earnings growth, better than expectations. And you've got a bit of a dichotomy with the broader economy because, of course, a lot of the driver of that growth is coming from AI, which is playing an increasing role in the economy, but isn't the whole thing at this point. But 20% earnings growth from US tech, we're looking for 18% next year. That's a big share of the index, and that has a big tailwind on US stocks. So we think earnings expansion is really the main driver of the upside that we foresee over the next year for equities and US equities in particular.
Do you think multiples go any higher, or do you think that they kind of come down from here?
I think it is going to be challenging for multiples to move much higher. We're in the 99th percentile now for US equities, so I don't think it would be reasonable to be expecting to see multiples move higher. And over the coming years, they are going to have to come down, and we think earnings growth will help that. Of course, the Fed cutting interest rates should mean that the multiples are quite well supported. We don't typically see very big contractions in multiples unless you start having tighter monetary policies. So, we think that broadly multiples stay roughly where they are, and then it's earnings growth that really drives the further upside for stocks from here.
Does the currency depreciation over in the States have any impact on fund flow, or is this still a sell America environment?
Yeah, so I think that rhetoric and that sort of notion has died down a little bit in the past few weeks as people have just been reassessing how far has the dollar fallen. But we do think that the general trend is going to be for more overseas investors to be thinking a bit more carefully about dollar exposure and also hedging their exposure to US equities. We've had for many, many years, people have been very comfortable to hold dollar exposure. It's been a safe haven. It's had decent interest rates. Now, some of those things getting questioned, the interest rates coming down. So what we're speaking about with clients, particularly in Asia, is around how can they get that US equity exposure so they're still exposed to that growth play, but also think about how to hedge that currency risk into things which are perhaps more suitable for their own personal situations.
KIRAN, I know we asked a little bit about your views on France earlier on in the conversation, but just to dwell on that for a moment, because that is really where we're seeing weakness today. So we're down by 1.8% on the CAC 40. Some of the big names in French banking losing ground, BNP Paribas and SocGen both down by more than 5.9%, AXA down by 6.5%. Is this threatening to become something that starts to dominate the European equity conversation, KIRAN?
Yeah, well, I mean, I think if you've got uncertainty in the French bond market, uncertainty about the deficit, that's obviously going to start to have a big impact. What we've been speaking with clients about is really looking at investment-grade corporates as a preference over sovereigns, particularly in parts of Europe. We think that generally they're going to have more stable credit profiles, perhaps a bit less exposed to some of the political concerns. And then within Europe, we've also been looking at allocating a bit more towards German bonds rather than French bonds, again, more limited concerns around the deficits and the fiscal situation. So, certainly something which, can have a big impact on broader markets, but we do think that there are, ways that investors can sort of mitigate some of the risks that may come around specific countries' fiscal situations.
KIRAN, what is the most recommended diversifier right now? Is it gold? Is it bonds? Is it crypto? What are you recommending to your clients?
We think gold is still the right place to be. We think that with rising debt, these concerns in France, we've obviously had the concerns in the US. Got some fears about where is inflation going to shake out in the US. We've got the Fed cutting interest rates. We've got the dollar weakening. All of that still speaks very well in favour of gold, and it's really proven its worth over the course of the past year or so. So we think that gold is still an effective diversifier. And it's a 5 to 7 year. The spreads are yields in absolute terms.
We're going to leave that.
Still decent.
We're going to leave it at gold. That seems to be where we're going to park that one. There's some technical issues, obviously, with KIRAN's line. Thank you very much indeed. KIRAN Ganesh, multi-asset strategist at UBS Global Wealth Management, Chief Investment Office. Let's look at the core six, figure out what is happening there. The French market is certainly the epicenter of the action this morning, and as you can see, LVMH is only down by 0.4%. But elsewhere, you've got Schneider down by nearly 2%. The market over the last 2 days, Monday, Tuesday, is now down by 3.6%. Let's talk more about what is happening out there. Louise Moon's here with the details.
We're starting off with Orsted today, trying to reassure investors today ahead of a stock sale. Shares up just over 1%, so slightly into the green, having lost 16% to a record low. So pairings getting some gains after yesterday's fall. Next up, we're looking at defence. The key ones today are Saab and ThyssenKrupp, both down into the red despite Mark Carney visiting the German defence company's factory today and potentially winning some contracts with Canada, but both down into the red. ThyssenKrupp down over 1%, Saab just slightly down into the red. Next up, we've got Kingfisher down 3.7%. That's after it was cut to a hold at Deutsche Bank, so not good news for the stock, weighing on Kingfisher, the UK-listed company, today. Next up, after Kingfisher, we'll move on to the next slide. We're taking a look at Associated British Foods, AB Foods, owner of Primark, big sugar unit, and a host of other businesses, down almost 4% today. They've been cut to a sell by Deutsche Bank. Also, that's on being undervalued. Next up, also, we're looking at Commerzbank, the German bank, also down into the red, over 5% into the red this morning, also cut to an underperform. That's from the Bank of America. Next up, we're looking at Puma, down 2% into the red this morning. Their owner is evaluating options, potentially a sale, so that's weighing on their stock this morning. And finally, moving to BAT, British American Tobacco. They unexpectedly announced their CFO is leaving, and that's weighing on the stock this morning, almost 2% into the red.
Thanks, Louise. Louise Moore from our equities team with some of those individual movers. A sort of layer on top of that, of course, the risk we now see in French markets. And it's worth emphasising the selling we're seeing on the CAC 40 for a second day. We were down by over 1% yesterday on French stocks, and we continue to see weakness, more weakness, in fact, today. The CAC 40 was down by more than 2%. It's pared those losses a little, down by 1.9%. But this is a fast-developing story and something that's turning out to be quite substantial. The weakness coming through then, as we've been saying it this morning, in the banking sector, in the insurance sector, luxury with its international exposure. It's not higher, but it's proving an area of resilience, perhaps, in the French market, relatively speaking.
Yeah, these are some massive moves that are not matched in the bond market. And I think this is pretty crucial, perhaps just simply because we did see that reaction in yesterday's session. But I'm looking at the French bond market here, and just, a classic vanilla 10-year. We're still at 3.5%. You look at the spread relative to Germany or Italy, again, this is not matching the level of panic we've seen in previous iterations of no confidence votes, of regime change, of new leadership, or even new budget proposals. I think we saw a bigger reaction when Bayrou suggested 2 days off of the French calendar.
Which is still part of the conversation, isn't it? Still one of the things that's being debated and pushed for by his government.
I think you need to take a step back, though, when we think about the French banks. Yes, SocGen is down and down hard this morning. The CAC is down by 1.9%. SocGen, GLE came in at the beginning of the year at 27. We're trading even after the drop that we've seen over the last couple of days at 52. It hit a high of 58. This is a stock that has absolutely rocketed this year, as has the whole of the European banking sector, which has been the key driver of European performance. So we are coming off... We're coming off a very strong move in French banks.
Yeah, to your point, Kriti, if we do see this calmness persist in government bond markets, and that's probably a dangerous thing to say. We do see some money going into German bunds this morning, which suggests that there is some risk aversion out there and some move into some of the more haven bond markets. But if we do see that, if we see that stability continue, does that put a lid on the losses we see over in France in the banking sector? That sort of loop.
You would have thought, yes. So French bonds are stable. The banks should be stable. The other thing as well is all of the conversations we had with the CEOs, CFOs of these French banks. What stood out? Trading.
Yeah.
Trading was really strong as a profit driver for these businesses. Yeah. What are we getting today? Nice trading environment, bit of volatility. Lots of things can happen, as a result of which maybe that feeds back into some good numbers. Yes, they're going to take a hit maybe on other areas, but trading, this looks like volatility to me. This looks like a good environment.
And we'll see how long it lasts. The French market then, the CAC 40 down by 1.8% right now. Coming up on the programme, shares of Ørsted, as we were hearing earlier on, hit a record low yesterday after the Trump administration halted work on the Danish firm's offshore wind farm. This conversation is still live, though, because now Ørsted is going to be meeting its investors and trying to explain what it wants to do with the money it's trying to get from them. So we will be focused on that conversation next. This is Bloomberg.
Tilting at windmills, attacking an imaginary foe that doesn't really matter. Shares in Ørsted are sharply lower once again. The Danish firm stock hitting a record low yesterday. This after the Trump administration halted work on the company's offshore wind farm in the United States. Christian Weinberg joins us now, Bloomberg's breaking news editor, to talk about this. Got a big meeting today. Ørsted's in town here in London, trying to reassure shareholders ahead of a $9.4 billion share sale, which looks like it's getting harder and harder to make the maths work on. What do we think is going to be said today?
Good morning. Yes, I think that's a very good question, because one thing that you want when you buy shares is you want visibility, and that's the one thing that Ørsted isn't really to give the potential investors visibility, because no one really knows where this will land yet with the U.S. wind project. So that's a massive challenge for Ørsted's management to reassure investors to go into this project long term.
Christian, the Trump administration has reversed course in other wind projects now outside of just Ørsted. Is this the beginning of a longer-term trend that affects the entire renewable energy sector?
Well, I mean, there are also bright spots here. I mean, you saw how Equinor, the Norwegian energy company, they were able to kind of overturn opposition from the U.S. administration on their wind project earlier this year. So it seems like there is also the option of getting getting these decisions overturned. And this is actually where there's some good news for Ørsted specifically, because Equinor owns a 10% stake in Ørsted and has told Ørsted that they would help the company and share their learnings on how to get a decision overturned. That might help Ørsted with their Revolution Wind project.
Christian, thank you very much. Christian Weinberg, Bloomberg's breaking news editor. We continue to watch the wind sector then as a result of all of that complicated, those complicated decisions and that push from the Trump administration. Let's focus in on France, though, because once again, this is an area of weakness for European equities. We're now down by 2.1% on the CAC 40, and some of the weakness coming through on SocGen, down by 7%, BNP Paribas down by 7%, AXA down by over 5%, Crédit Agricole similarly. Let's get to our French equity markets reporter, Julien Pontus, who has an update for us. And a lot of this seems to be sticking to the banking sector, the insurance sector, Julien, even though bond markets on day two seem to be a little more calm. What's happening here? What's the headline?
There was still a big jump in the yield of French government bonds, and it's usually the financial space which takes the first hit. Now, if you look at the broader SBF 120, which is a bit equivalent to the FTSE 250, domestic companies, they're getting hit as well. I think anything that's linked to financial, so the French government bonds, or the domestic economy is getting hit. Basically, it's a comeback of the political risk that was always there in the background since Macron dissolved the National Assembly, but it's making a comeback, a very sudden comeback, I think, that took a lot of investors by surprise. But it's the usual suspects that are getting hit. I think investors are selling first, then will ask questions later. But that being said, there's nothing in the short term that could bring some relief. The vote in Parliament will come in September, and so in between them, it's a tough one for investors.
Okay. Julien, is the market pricing another French government, i.e. Macron just gets another Prime Minister, or is the market now pricing the possibility of early elections?
I think we're in between. I don't think they're pricing another election at the moment. I just spoke to an investor who told me, like, his belief is that we could get a status quo, like we had with Barnier and Bayrou, and then get another, like, center-right, center-left person to keep trying to get the government rolling. So we're not in a position where, you know, people are going to price, oh, maybe a far-right government coming in after elections. But we're getting there. What people are really focusing on is the spread with Germany. France is getting close to that of Italy, and that would be really a big milestone. And I think that would mark for investors the sign that, you know, there's a big change in political risk assessment in France.
Okay. That certainly would change the arithmetic fairly quickly. French equity markets reporter Julien Pontus, thank you very much indeed. What do we need to talk about? We also need to talk about what is going on elsewhere. Do you hide out in gold in all this instability? I think is one key question. We were hearing that a little bit earlier on the programme. Olisoth HANSEN, head of commodity strategy at SAXO Bank, is going to be joining us. We'll talk about the Fed, we'll talk about the gold story, we'll talk about what's happening with the dollar. All of that is coming up as we watch the French market continue to struggle. This is Bloomberg.
Welcome back to the opening trade. 30 minutes into today's session. If you were expecting some positivity, turn the other way. You were seeing red across the screen. Yesterday's sell-off continues, and it is really permeating and snowballing in France. Down 2.2% over in the CAC 40, but really bleeding into the rest of the continent as well. Your best performer this morning is going to be the FTSE 100. And, Guy, it's down 0.7%.
Yeah, it's a relative trade. It is still down, but it's still doing better than everybody else, which I think is interesting. Which takes us on to what we're talking about here. You've only got 70 members of the stock 600 that are higher. 524 are lower. And last time I checked, every single stock in the CAC 40 was down. Whether or not that continues to be the case, we'll wait and watch. Volume's actually okay. Volume's picking back up. You would have thought this would be a light week. London was out Monday. You got Labour Day coming up. You would have thought this would be a light week, but there's a lot going on out there. Let me just highlight maybe some of the reasons why the FTSE 100 is outperforming. It's got a few of these. Miners, Antofagasta, 52-week high. Actually, it's only been over the last 2 or 3 months that this stock has started to really gain some traction, and you can see that off the April lows. We picked up really sharply, but this stock is trading at a 52-week high. This is a copper story. This is, to a certain extent, a China story, maybe a bet on the stimulus narrative coming out of it as well. We'll talk about gold in just a moment. Are hard assets where you want to be? And maybe that's one of the arguments around Antofagasta right now. That's the stock story. There's a lot going on out there. There's plenty of factors this market needs to know about. Anna, what are we watching?
Yeah, let's get up to date on some of the other news stories that are certainly influencing markets overnight and into this morning. President Trump has moved to oust Fed Governor Lisa Cook following allegations that she falsified mortgage documents. But Cook is pushing back, saying she will not resign and the president has no authority to make her. Her lawyer says they will take whatever actions are needed to prevent President Trump's move. US President Donald Trump is threatening to impose fresh tariffs and export restrictions on advanced technology and semiconductors in retaliation against other nations' digital services taxes. Trump posted on social media that the measures are, quote, designed to harm or discriminate against American technology and give a pass to China's largest tech companies. Over in France, Prime Minister Francois Bayrou has called a confidence vote over his budget proposals that could topple France's government next month. The vote is an effort to consolidate support after pushback against 44 billion euros of spending cuts and tax increases that he considers vital to avert disaster for France's public finances. And this French story certainly gripping equity markets, even if it's not necessarily dominating all other assets then this morning, Kriti. And I was trying to think what's different today versus yesterday, because we got this at the end of trading yesterday. We heard from Bayrou that he was going to call this confidence vote. But what has changed is what we've heard from all these opposition parties, the fact that they have already declared that they will vote against him. And so his position looks increasingly perilous. Of course, we have many days to play out. A lot of politics, no doubt, will play out. And we'll get an update from our colleague Caroline Conan on the politics shortly. But that seems to be where the market is focused. And as a result, we see another day of negativity for European stocks.
A massive day of negativity. It feels like, though, the summer has been a positive one for Europe. The first, I want to say, 8 months of the year have been a positive one for Europe. So is this a moment also to take some of the cash off of the table? The other piece of this, though, Guy, is simply that not only is this a, as Anna suggested, kind of a no-brainer, and then now that all these oppositions are saying we actually don't want Francois Bayrou, but just 4 weeks after that no-confidence vote, September 8th, you have a budget due in Parliament.
The question, and this was the question we asked Julian Pontus a few minutes ago, is are we past pricing just a new government? Are we pricing now the possibility of early elections? And that'll be something that we're going to have to watch out for as well. We're also getting some live pictures right now. Mark Carney, Friedrich Merz, the German Chancellor, the Canadian Prime Minister, just starting a press conference in Germany. It's going to be interesting to hear what they have to say. It's interesting that Carney, once again, is in town. Obviously, Merz is going to be speaking in German. I'm assuming that Carney won't be speaking in French and he'll be speaking in English. So maybe we'll listen in on just a moment. But it's interesting that the relationship between Canada and the Europeans seems to be going from strength to strength right now.
Well, and it does link a little into what we're seeing, the nervousness about the French fiscal situation, because one of the many reasons France has an issue with its French fiscal backdrop is to do with the increasing pressures to spend more on defence. And we know that that's going to be part of the conversation with Mark Carney in Europe and certainly in Germany. He's talking about defence, shopping around for submarines, we understand. But that defence story is one of the reasons why we're so nervous about some of the European fiscal stories.
Defence, intelligence, aligned foreign policy is going to be a key piece of this as well, especially ahead of the UN meetings in September and some of the policy decisions the French, the British and the Canadians have chosen to make. There's also that key piece of do you have a united front on the trade front with the States?
We're getting very excited about European fiscal expansion. And basically what we mean is German fiscal expansion. Are the French going to, in some ways, counter that, slow it down in aggregate? And when we think about what is happening in the European economy, this is still a huge economy that is struggling on the defence side. Can it fund its defence spending? Can it fund does it have to have higher taxes? Is that a drag? You do wonder kind of what the offset is between Friedrich Merz's free spending, which I'm not sure is going to be delivered upon in its entirety, and what is happening in France at the moment.
And France, previously when we covered this story, I remember France looking to share what it does have. So it doesn't have headroom to borrow a whole lot more and increase its defence spending, but it has a nuclear deterrent, and that is something that in a European context it might be able to start conversations with others about. But yeah, fiscal
doesn't change the
constraints.
economics.
No.
Anyway. Let's carry on the conversation and look at where else you could be parking your money this morning. If you worry about what is happening at the Fed, if you worry about what is going to be going on in the United States, potentially driving higher inflation, if you worry about instability, political instability here in Europe, is gold the place you want to be parking your money? Ollie Hansen, Saxo Bank's head of commodity strategy, joins us now to answer that very question. If you think about what is happening in the world, good morning, by the way, do all roads point to gold? Gold has had a great run. Is what we're seeing on our screens this morning only going to encourage more people to put more money to work in the precious metal space?
Well, good morning, Guy. It looks that way. We have seen demand for ETFs picking up in the last few months, while gold has actually been trading sideways. We're a bit of stuck in a bit of a holding pattern here, $200 range with the top around 34.50. The news overnight, especially with the Fed independence being at risk, is not driving it towards that level yet. I think for that to happen, we simply need to see lower funding costs. We need to see rates coming down in the U.S. and obviously with what's happening right now at the Fed, it could indicate that time is coming soon and perhaps faster than what the market is pricing in.
Is it just hard assets more broadly? If you assume that we're going to be seeing interest rates being driven lower, and at a time when potentially inflation is going higher, is it gold or is it just a whole range of assets? What does the portfolio look like if you think that is the operating environment that we're heading into?
Well, in an environment where we're seeing rates coming down, then obviously if we combine that with hard assets where supply is relatively tight, then obviously you have quite a strong story for higher prices. And we're seeing that obviously in the gold market. We're seeing that in silver as well, probably more so than gold in terms of supply, but also some of the industrial metals. Copper is always one that attracts a lot of attention. It's also just in a holding pattern right now. But if we are moving in that direction, then hard asset with tight supply, as funding rates come down, they're the ones to look out for.
OK, and with tight supply, you mentioned there, Ollie, good morning. So that puts it in a different camp to some of the other commodities that you follow, and I'm thinking of oil here, where the focus has been on increasing supply, of course, from OPEC+. But I want to ask you about what you're watching on the oil story when it comes to India, its relationship with Russia, this policy of secondary tariffs, as they've been described by some, that the Trump administration is looking to put on India. How much is that capable of reshaping energy markets?
Well, it will have an impact if they are putting these additional tariffs in place and India starts to budge. Then there could be some tightness coming from that front. But at the same time, we have to remember that the 2.5 million barrels that OPEC Plus, the 8 members agreed to this year, we only seen part of that hit the market yet. So they're still holding back. Some still have some have been overproducing, and they're compensating for that right now. But also others, including Saudi Arabia, they are obviously just watching what the demand situation looks like. So I think even if we should see some tighter supplies coming out of Russia, then the overall market, I think, has got enough supply to mitigate that. But obviously it will change some of the trading patterns and the routes that we see with oil being shipped around the world. But I think there is ample supplies, and that's why as well, if you look at Brent, we have been traveling higher now for the past few days. And once again, as we approach 70 in Brent, 65 in WTI, it looks like we're heading a little bit of not a brick wall, but at least some resistance there.
So there's lots of supply. Supplies are not tight, but these policies on secondary tariffs could reshape trading patterns a little bit. Does that mean are you watching where the US sends its energy, its commodities to, Ollie? Because maybe that is what White House policy is all about, trying to export more energy assets.
That will obviously be a major focus, and one that can soothe the White House if we are seeing a pickup in demand for their energy. And it's interesting to note right now that the WTI crude price is actually, well, it's still obviously trading Brent, which it should, but at the same time, it's also where the speculators are actually holding the least optimism about higher prices, and that's, I think, is probably also part of the story right now, simply because we are in a holding pattern, we're in this range-bound market, which means that some of the speculative interest from time to time will have an impact on the market, and we're just right now seeing a first ever short position being held by money managers in WTI, and that is, with the markets obviously going up for a few days, that is supporting an extension to that move, which I think is now potentially starting to run out of steam.
Ole, it's Kriti in London. I want to pick up on the point that Anna made when it comes to the ripple effects of India. She was talking about it from an energy perspective. I'm curious about the metals perspective. India is both a big importer and exporter of gold and jewelry. As we talk about 50% tariffs getting slapped onto India as of midnight tonight, what is the ripple effect into this market, or is this something that's already priced in?
I think it's mostly an energy story. Obviously, India is a major trader, as you say, in precious metals. But it's that the trade with the U.S. mostly one that's going through Europe, I would say, and that's really where we see the Swiss has been stuck in between a rock and a hard place, because such a big part of their sale or export to the U.S. is gold, and we have to remember they're not actually making all that money. They're only making a small margin for refining that gold. So I think this is. The gold story is still, when it comes to trade and tariffs, is still primarily one between Europe and the U.S.
Well, Ole, I'm so glad you brought up the Swiss story, because I'm curious, even though some of those at least considered tariffs or rumored tariffs were ultimately pulled back and rescinded by the Trump administration, or I should say quashed, it did certainly have an impact on the gold market. Do you foresee that market getting tested again now that we've seen it happen once?
I certainly don't hope so, because it's just creating a lot of uncertainty in the market, and when you have these barriers suddenly coming up, we saw that obviously with the copper story, and we all know how that ended. It's not good for a market, and especially with the gold, when it is a key part of central bank's reserve and is treated in a different way than any other commodity, which is primarily just used for demand towards production and so on. So I think with that in mind, I think that even the U.S. administration got a bit surprised about the impact that these announcements had. So good that they were removed, but we don't need those kind of obstructions in a market that needs to be depending on free flowing and this kind of triangular route between Switzerland, London, and New York.
Well, Ole, coming back to Guy's point at the start of the segment, he made the point that gold is the ultimate hedge right now, or at least it seems to be from every market voice that we speak to. So how do you hedge the possibility that the hedge itself could be under tariff pressure, supply chain pressure, et cetera, now that, again, this has been put into the ether?
Well, I think the market is really there is obviously a risk that the market is too one-sided at this point, but I think also we have seen for a while now that even though there are obstacles being put in the way, that these have been relatively short-lived. So I think right now the market is just basically getting ready or getting used to these higher levels. It's also central banks. And once we see the breakout, then we will see that move higher. But we need to take out 34.50 first.
All right. Ole Hansen, Saxo Bank's head of commodity strategy, we thank you so much for your time walking us around the world when it comes to that commodity story. In the meantime, we've had a press conference from two world leaders.
Mark Carney's currently speaking. He's talking about critical minerals, which I think is really interesting. Canada's got a lot of them. The kind of minerals that Europe needs, the United States needs, that China and Russia are currently supplying. Are we going to see a shift in that? The problem with this is that, yes, Canada's got a lot of this stuff, but it takes a long time. We are learning that refining rare earths is a very complicated process. China has spent a long time building up this core competency and now has key strength in that and is leveraging that key strength. So, yes, we can talk about the fact that Canada has these resources, making them viable and deliverable in the near term is something that presents a massive challenge.
Yeah, we're talking here about a host of metals. He's talking about nickel, cobalt, graphite, rare earths, things that Canada can help Europe secure in the face of its previous supply chains. No, not quickly.
And that's the problem. China spent 20, 30 years building up its competency in this space. and this is dirty, hard, difficult to do, and China has got the lead and therefore has the whip hand on this in terms of controlling these markets, which I think is really important right now, and in some ways holding the European defence industry, American technology industry hostage as a result of that.
Absolutely. We're going to continue to monitor that press conference and, of course, the relationship between these two countries as they speak in Germany. Coming up on the program, though, taking a little bit of a different angle. We're going to take a look at the state of the credit market in light of record tightness when it comes to those spreads. Stick with us. This is Bloomberg.
Welcome back. 8:49 here in London. This is the opening trade. Our conversation is very much dominated by French equity markets, down by 1.8% today on the back of political risk. But let's talk about other risks that might or might not be out there. Let's turn to the credit markets. Spreads may be seeing record tightness and a price to perfection, but there are always risks. Could credit investors be too complacent? For more, we're joined now by Mahesh Bimalingam, who's Global Head of Credit Strategy at Bloomberg Intelligence. Mahesh, it is very nice to see you on set with us this morning. Can I ask you about, then, what you're seeing in credit markets? Are you concerned that things are overvalued, given how tight spreads are?
Yes. I mean, credit is definitely at, if you look at US credit, it's like at a 30-year tights. If you look at European credit, we are at post-2007 tights. Asia is tighter than us in terms of raw terms. So, yes, credit is tight. If you look at it on a volatility-adjusted basis, credit is rich. Is it 2 standard deviations rich, where we call for a turn? It's pretty close. So on all those measures, yes, it is tight, it is rich, but it is justified. If you look at how fundamentals have held up through tariffs. All credit ratios held up, profit margins held or improved, leverage ratios in control, despite very high interest rates, coverage in control. So corporates have been quite disciplined, unlike the alternative, which is my main thesis.
Okay, by that he's hinting at governments.
Yeah.
So credit looks better than govies.
Oh, definitely. So I think a chart should pop up, which clearly shows that credit is at least 3 times less volatile than govies. So much for the risk-free, right? The risk-free is at least 3 times on average,
yep.
And depending on when you look at it, it's even 4 times more volatile. And think about it. Would you lend to a company which makes a loss every year and is forecasted to make a greater loss every year going forward, which is governments?
Yeah.
So would you lend to that, or would you lend to...
So that's the driver into credit.
Yes.
Sure, but Mahesh, that's been the case for a very long time. That's been the case since 2011 in the States.
Yep.
So why do you feel like the market is right this time around for that perception?
I think we have a much bigger, serious issue now. Yes, the Eurozone crisis was separate. It's very Europe-specific. But now we have a worldwide issue, particularly in the West, where you got, demographics going the wrong way. Government deficits are only going to get worse, particularly in economies where you got, large welfare states and so on. So as politics tries to make that difficult choice, you're going to have increasing deficits, particularly in countries where they can't print, right? Like the Americans can, but the European countries cannot. So compared to European govies, European credit, for example, looks a much less volatile asset class.
Well, maybe, Germany's busy talking about buying more submarine... Germany's busy talking about supplying defence to Canada this morning. We're watching pictures of that coming in right now. So maybe Germany argues that it can spend on its side.
That's one exception.
That's one exception. But is it all rosy, or are there things to be concerned about? I was reading a story just at the end of last week about risks piling up in private credit markets. Is that the area to worry about?
I think that's a very good question, because public market, you can track, you can follow, and you can see that default rates are very low. Still, credits are getting upgraded. There are a lot more credits going from high yield to investment grade. So all of that is fine. So where is the problem? The problem is in all these credits that cannot finance in public markets going into private markets.
Yeah. We're just moving the problem.
Yeah. And the thing is, you can't track it. So the thing is, the next domino in credit markets to fall will be in private credit, where you might get much higher default rates than what you are seeing in the public markets. Public markets default rates are 2.5.
Does that isolate any potential risk, though, to the private market, so it doesn't have a systemic ripple?
Why does it not have a systemic?
I'm asking. That's the argument. That's the argument private credit bulls are making.
Correct. So the logic is that in terms of size, particularly in Europe, private credit is small. In the US, like it's about, I mean, we don't have accurate numbers for this. In the US, it is about like $1 trillion. But compared to public markets, it's still small.
All right, Mahesh Bimalingam, Global Head of Credit Strategy for Bloomberg Intelligence, joining the program this morning. We thank you so much. He was talking about the crisis in govies. Let's go to one of them right here in Europe. Prime Minister Francois Bayrou has called a confidence vote that may topple France's government as soon as next month. Now, the move prompted a sell-off in French assets as investors hedged for even more political uncertainty. 3 political parties immediately saying they would vote against the motion. Bloomberg's Caroline Conan covering the story for us in Paris. Caroline, the Prime Minister has admitted this is a risky move, could cause more instability. What do we know?
He's testing the waters, but these are clearly very dangerous waters. He's trying to anticipate the social anger by calling this vote of no confidence on September 8th, which is 2 days before some far-left groups have called for a general strike in France, threatening to block the entire country on September 10. The entire summer, Francois Bayrou made a point about not taking any summer vacation, trying to explain his budget, trying to explain why it's important for France to save 44 billion euros in the next budget. But this doesn't really seem to have paid off. And last night, immediately after his press conference, the National Rally of Marine Le Pen and the far left immediately said they will not support Francois Bayrou for this vote of confidence. The socialists were a bit more vague, and in fact, this is what the government was hoping for. When we spoke, for example, with the finance minister, Éric Lombard, in July, when this budget was initially proposed.
There are probably more possibilities to reach an approval with the Socialist Party. They are still a party in the opposition, but they allowed the budget to pass for 2025. And if we have a fair discussion with them, and we will have a fair discussion with the Socialist Party, hopefully they can support the government for the budget. But again, we will talk to all parties, and we hope to have a wider support.
But now the socialists are saying they might not support the confidence of Francois Bayrou. So chances of a government collapse on September 8th are very high.
Yeah, and then what comes after that, I guess, is the critical question. Caroline, thank you very much indeed. Caroline Conan. Are we heading towards fresh elections, or do we just get another government, I think is the question the market's kind of beginning to work its way through on this one. A busy morning, much more busy than maybe we anticipated.
Yeah.
Is tomorrow about this, or is tomorrow about Nvidia? That is the key question.
Right, well, Nvidia is still some time away, isn't it? Because after the market on Wednesday, so maybe we have another day to talk about Cook and France.
The party continues. That does it for the opening trade. The Pulse is up next. We'll have it all covered. Stick with us. This is Bloomberg.